welcome back to this week's market update. Today is Monday, October 21st, 2024, and with that, we will jump right in. Last week, markets saw continued positive momentum with retail sales exceeding expectations and earnings season coming up into full swing. By Friday, October 18th, the Dow Jones Industrial Average led the major indexes up just shy of 1%, followed by the S&P 500, which was up 0.87%, and the Nasdaq Composite up 0.78% on the week. On the other hand, though, bonds were nearly flat after a short-lived midweek rally, with the Barclays Agg up 0.05% on the week. Heading into our economic updates of the week, we got retail sales figures for the month of September, showing a better than expected 0.4% rise in total retail sales. On an annual basis, though, this was just 1.7% higher than September of 2023. So when you subtract out the current CPI inflation rate from September of 2.4%, actually shows a negative real decline when adjusted for inflation of about 0.7%. So on an annual basis, when adjusted for inflation, retail sales are actually down slightly, just less than 1%, but overall did come in better than economists had expected for the month. By category, you can see auto sales was a very flat category in the month in terms of growth, followed by other categories like non-store retailers, which were actually a positive contributor to retail sales, up 7.1% from a year ago, while sales at food and drinking establishments rose by 3.7%. So a very mixed picture in this month's retail sales. It was better than economists had expected for September, although it does continue to show the overall slowdown that the economy is in post-pandemic. Moving along with our week, the residential real estate sector continues to face implications of higher interest rates, even as the Fed began cutting rates last month. This was seen in September's housing permit starts and completions report that came out last week. So building permits, the first step in the new residential construction process, a proxy for future projects, came in at 1.43 million. This was down 2.9% from August and 5.7% from a year ago. So that will likely show up in the housing starts and completions in the coming months and years, as this often has a lag between the time that a builder gets a permit to the time that they are completed with the house, obviously. Moving along here, we had housing starts come in at 1.35 million. This was a decline of 0.5% from August and a decline of 0.7% from September of 2023. So not a huge change there. And then last but not least, we've seen housing completions, which lag the higher interest rates. That was up to 1.68 million, which was a increase of 14.6% compared to the same time last year. So there is an increasing amount of housing supply entering the market due to the lag in the new builds during the 2020, 2021, 2022 era when interest rates were extremely low before the Fed started hiking rates. And that's when a lot of projects were started and now they are being completed, adding to the new supply here. So in a bigger picture, a more macro view from this month's report, just wanted to point out how the housing shortage has significantly impacted the real estate market, which has caused housing prices to go up. So it is a combination of higher interest rates now that we've seen since 2022 when the Fed started hiking rates, but it's also the fact of a lack of supply entering the market. So here you can see the abundance of new supply entering the market before the '08 crisis, and then obviously that fell off as the US economy went into a recession, and then now we've been in an uptrend ever since then, but not quite at those same levels. We peaked above that longer term average here slightly in 2022, 2021, when interest rates were extremely low, but that has since fallen off. So the question now is, are we going to continue in this upward trend when new housing supply will continue to enter the market, or are we going to stay flat, or are we going to head down, maybe if the US is entering a recession? So lots of questions here, but good things to note as we just take a whole view of the economy, all the macro drivers that we look at on a daily and regular basis. Moving along in our week, as of Friday, 14% of the S&P 500 have reported their Q3 earnings, with the overall results appearing mixed. The percentage of companies exceeding earnings expectations is higher than longer-term averages. However, the size of those earnings surprises is below historical norms. So companies are beating their earnings estimates, but at a less bullish pace than historical norms. Financials, often viewed as the earliest to report sector, have been outperforming expectations. So you can see they're currently expected to post about 5% annual earnings growth as compared to the negative 0.5% decline that was previously expected as of September 30th. So financials surprising analysts to the upside, and that's been a driver of the market's movement in the last week or two. Other companies, though, other sectors have been revised downward. We've seen energy that originally was at about a 19% earnings decline expectation. Now analysts are expecting earnings might decline in the sector as much as 26%. Industrials, the same trend, and even healthcare still expected to post positive earnings growth, but at a less bullish pace than previously thought of a few weeks prior. So overall, very mixed earnings growth report. Analysts still expect about 3.4% earnings growth compared to a year ago across the S&P 500, which would be not bullish but not bearish, so just kind of stable in that metric there. But when you look at the sectors that are expected to lead, we see tech, communication services, real estate. And so when you see these sort of sectors leading in earnings growth, it does not look like a recession. These more cyclical sectors, especially real estate, consumer discretionary, that's more flat. Those sort of trends lead us to think that there is not a recession impending, but perhaps a larger economic slowdown. Last but not least, we also are just going to take a quick look at our recession indicators as of last week. So we got an update in the Philly Fed's Manufacturing Business Outlook survey that showed a positive change in the month of October. So that remained bullish in our recession indicator dashboard. Overall, we have four bullish factors. You can see those there, as well as the ISM Services Index, the Employment Trends Index, and the Chicago Fed National Activity Index. So all four of those look bullish. And then on the bearish side, we have the weekly Philadelphia Fed ADX Index, the ISM Manufacturing Index, which has been bearish for quite some while, and then the leading economic indicators, those are also a bearish indicator, while the anxious index, which shows the probability of a recession, that has been neutral for quite some while now. So overall, we are cautiously optimistic. We do recognize there is an economic slowdown happening, but we think that this is looking like a more normalization rather than a full-blown recession. So with that, thank you so much for tuning in to this week's market update, and we look forward to providing another update to you next week. The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.